everyone. How are you feeling today? I hope the lunch was good. Today we're going to talk about the RWAs, and we have our beautiful speakers. Just want to understand who is in the audience, who actually traded at least once on RWA, who bought at least one real-world assets. Okay, who knows what DeFi is? Who knows what the difference between centralized and decentralized exchanges? All right, so we have a quite confident audience here. So guys, please, I'll give you a word, introduce yourself, and maybe share one special fact so audience can come and basically with this fact start talking to you after the panel. Please, Mr. Mohammed.
Okay, thank you very much, and thank you for everyone for your time, and I hope it will be very light and informative session. So I'm Mohammed Al-Kaf Al-Hashimi. I'm basically artificial intelligence engineer. I founded MCPM Group long back, starting from 2007. We focus on automation and artificial intelligence, but I also founded Haq blockchain, which is a layer 1 protocol chain, and cryptocurrency and another crypto exchange as well. So that's in brief. We also founded a fund that's investing in early stages Web3 startups.
Do you want to share something special about it?
Something special. I'm writing songs.
Wow. Yeah. Nice, Ben. The floor is yours.
Hello, everybody. I'm Ben from BNB Chain Foundation. My bubble is the RWA vertical. This category came kind of very natural to me. I was contributor to a RWA tokenization platform back in 2020. Was part of a MiFID II licensed broker, which enabled security token offerings in Europe, difficult jurisdiction for this type of assets. And yeah, you wouldn't believe it, but I'm pretty deep in ice cream also. So ask me anything about ice cream later. I know the real world struggles of operating ice cream businesses. So yeah, real world assets, I definitely know what the value it brings to the small business owners, big institutions, anybody from the real world touching the on-chain life, literally, yeah.
Beautiful. Yeah, Redwan.
Good afternoon, everyone. Thank you for coming to our presentation. My name is Redwan El-Kami. Redwan is red as a color and one as a number. That's how you remember it. My friend called me Blue for some reason. My job is a university professor. I'm a business school professor at the University of Toronto since 2011, and before that I was at the University of Iowa, MIT also. I'm an engineer by training first, before a PhD in finance. It means I started as an engineering career, electrical engineering in the 90s, and when the whole Bitcoin things comes up, while I was a consultant for pension fund, that's a side gig, since 2004, they told, oh, you're an engineer. Maybe you know something about these things that is coming up in 2013, 14. It's come up in 2009, but I was asked in 2013. And that's the best question somebody asked me, because I didn't know anything about it. And I end up investing in it, and the whole thing is history. I'm here to talk about RWA for now, but I'm an academic by training, and I'm enjoying. If you have any other question on anything outside, reach out to me. I'm happy to share whatever we worked on, whatever we're interested. That's the academic side. It means this is what I do, and hopefully we'll answer some of your questions on RWA. Many questions are unanswered even up to today to many people, including regulators. It means if you end up the conference and say I have a lot of questions, it's still okay, because no one have all the answers yet.
Yeah, thanks a lot. So guys, I want to share with you the plan for this discussion, and then please think about the questions that you would like to ask, because here's the professionals who maybe clarify some things that you have in mind and you don't know how to basically find the answers or where to find the answers. So the first block we're going to discuss will be basically around why RWA is happening right now and what was basically the story behind. The second block will be about what is really happening, what is the infrastructure, what is the compliance part of the RWA. And the last one, we're going to maybe brainstorm about the future and how we can scale it. So let's start from the first one. What are, guys, your thoughts? Why RWA is really a big trend right now, and why everyone start talking it just exactly this period of time, and not maybe, because about the tokenization, everyone talked about tokenization since 2017, and this is happening now. What's your thoughts behind?
Okay, so I think since long we were hearing a lot of people talking about RWA, but who will be the first mover to do it, who will be the first one to make it happening. I think now we are at the time where implementation and converting these all talks into reality are happening. We are lucky to be in UAE because UAE is moving from being a sandbox to be a rule book writer. Now, UAE is writing the rule book for RWA, is one of the most advanced regulatory framework, and it is one of the first mover to this. So I believe where things are happening now and moving now in RWA because the infrastructure is more ready than it was before. Before, people were scared from going to RWA. We're trying to configure how we can do RWA. Is it a technology only? Is it a mix between technology and assets? How regulatory is going to look at it? Is it security tokenization? And then we go into some fines, penalties, and we face a lot of headaches. Now, all of these components now are joined hand together and building a full ecosystem. It's happening now in reality. And I believe we can witness that there is, yes, fragmentation in the regulatories in the world. We can see some countries adopting this, some countries still rejecting this and consider it like something prohibited, or this is security tokenization, don't talk about it. But always luck is with the first movers, with the people who do it first. And that's why I'm saying the infrastructure here in the UAE is ready for this. That's why we see a lot of adoption, a lot of companies, a lot of people are trying to build this in the country, and they're getting a lot of support. In parallel with this, we are seeing also a lot of awareness. Like 2-3 years ago, if we say RWA, you still have to explain to people what does it mean and how it will happen. And especially people that are not into crypto, we have to simplify to them to understand it. Now is enough that you say RWA, a lot of people get it and they move forward. So this is in brief, I can summarize this in regulators now are more ready to regulate it and to have the framework for it. Technology providers, they are also ready to adapt their technology and make it cope with the regulations to move forward. And the asset owners, if you talk to them in the past, any real estate owner or even services or funds to say, let me tokenize what you're doing successful things, they will not listen, but now they are more ready to do it.
Yeah, thank you, Ben.
So we come pretty much from the bottom-up fields, right? So blockchain technology is a bottom-up revolution. I personally believe that this RWA tokenization narrative really makes sense. Already 10 years ago, the infrastructure was ready 10 years ago for this. But as Mohammed, you also mentioned, there's also regulatory infrastructure that is needed for any business, not only big institutions, but even small business, to be able to tap into this market. It's just a normal thing. If you spend so much time building a business, you don't want to lose your operating license, or you don't want to take risks which can potentially completely drown your business. So this is why we're right now at this time where we see this regulatory shift, and there's been even so. What's surprising for me at the moment is that large institutions are really adopting blockchain technology from top down, and while they are adopting blockchain technology at such a fast pace, I see maybe that the retail hype is maybe not at the levels that it was 5 years ago, which is very surprising to me, actually. So yeah, just to sum up, institutions are looking basically for the best technical infrastructure. Right now, there's seasoned blockchains which can offer the best technical capabilities, fast transactions, depending which standard you're building on, EVM, Rust, whatever it is. It's technically a backend that you can use and distribute your assets. I see that this is mostly also the target of institutions. They want the best distribution. Some chains offer this better than the others. But at the moment, we are really at the stage where it's finally happening. And it's definitely happening at a very large scale. Just in the past year, I can just say for our chain, from BNB Chain Foundation, we were able to start with RWA, have it like a focus category, and a growth from start of the year from 4 million in RWA TVL to 1.6 billion just less than 1 year later is a huge indicator that things are moving fast at a large scale.
Ridwan, would you like to add something?
I think they say the majority of very interesting things, like the regulation side, and it's an extremely important one from the institution to jump in on anything, is the clarity on. But actually, I want to just make a little bit of a distinction first. When you say an RWA, for the majority of the people here in the room, basically you can tokenize a public asset like a stock, a treasury. You see a publicly traded, it's already public. When you bring it on chain, really what you gain is 24 hours, 7 trade-in, more liquidity, and you have an oracle price. You know exactly how things are actually priced. It's fine. That's not really a big benefit for institutions extremely. Okay, there is, but it's the big benefit that is going to be like, I predict, if the UAE does it right, and I'll give you an analogy, this is going to be the Eurobond moment for London. When London in the 60s, 70s, and the US let London start a trade of US deposits outside the US, outside the Fed, and they did an off-balance sheet trade of liquidity and provided liquidity for the US dollars outside without regulating it and do the off-chain, that's the moment for RWA, if they do it correctly. If the regulation is correct, it could be trillions of dollars moment for UAE. And why? Because private, everybody have real estate, hopefully, and if you don't have, you should have at some point. If you have real estate, can you sell a bathroom? No, how can I sell my bathroom? How can I sell my living room? No, you sell the real estate. What this RWA allow you to do is fractional liquidity for your real assets. You take your real asset, investment, a data center. You don't buy the whole data center, you buy a fraction of a data center. And now what you're really doing is basically making an illiquid asset that is sitting in your book waiting for an exit, which is trillions of dollars out there in the sovereign and the pension funds sitting in their balance sheet, waiting for it to dump it somewhere, and they're saying, okay, what do I do? There's no exit. There is no exit. I want to sell it. There is no exit. I want 5x. No 5x. I'm stuck with it. Well, now you can create liquidity for that asset by tokenizing it and creating a trade that is fractional of that asset outside the US. Doesn't matter. It doesn't have to be in the US. It can be in the UAE if they did it right. Again, because when I look at the regulation, and I just spent some time on it, they are doing something okay in my view when it comes to stablecoin, which is an AAD-based payment. I like that as a conservative argument. I'm not sure about the custodian side, because they want to limit self-custody and all that stuff. But I think they are in the right move. They're number one for sure. But if they do it right, this is going to unlock trillions of private assets sitting in the balance sheet waiting for an exit, especially if you follow the private. There is some debate on it, on the chain. It means this is the angle I wanted to add, is not just tokenizing liquid asset out there, it's tokenizing illiquid asset, but it comes with risk. There is an illiquidity trap, which we can talk about it. If we don't talk about it today, we can talk about it offline. There is a big trap that you have to make sure to avoid if you want to do it right. And history can tell us about what happened to Eurobond.
Yeah, and just to add on that, basically, the industry wasn't ready. I started, I believe most of you started when there was just 1% of people who actually own these crypto assets. And why we need to digitalize is just 1%. Yeah. It wasn't really fruitful for those who were tokenizing their assets. Now we see more than 10 or even like already, I think it's 14% that already at least own the crypto assets. And remember this beautiful thing happened when basically the president of one of the leading countries just launched their meme coin. How many people he actually onboarded? I can understand, right? They are not really happy about maybe the results of their entrance on the market. But then it's basically the floor is ours to educate people on how they can basically monetize their assets further, how we can use how they can use BNB Chain or Trust Wallet or Binance Web3 Wallet to then dive deeper into this industry and start trading the real-world assets. That's maybe something more. So basically, the market grew right now, but we still have some problems, and this is where maybe we can dive deeper into problems or maybe some, improvements that we need to do, which is maybe cross-chain liquidity compliance part. And also one maybe quick follow-up to you, Mohammed, as far, or maybe also to everyone, to the panelists, as far we are talking in the UAE, we are here, what are basically the real-world examples for the on-chain assets for the basically Sharia compliant and ethical digital assets? What do you see there here right now?
Well, thank you, Sasha. This is an important question actually, because when we talk about ethical assets and when we talk about Sharia compliant, I would love to bring the audience attention first that we're talking about a market of, today it is $5.5 trillion market cap, expected to be $7.5 trillion in 2 years. So we're not talking about something for a special community, and we're talking about something that's not exclusive for a special religion or a special people. It's something global. We talk about ethics, and people are in need for this. Now, when we talk about it and we look at the real-world asset tokenization, we need to realize one fact, that today, for example, the halal products ecosystem, it's growing very fast, and the Sharia compliant finance growing very fast. Sukuk itself, Sukuk is the Sharia compliant bonds. So Sukuk today is almost $1 trillion market cap. So it's growing very fast. And if we look at the Sukuk itself, I would say there is a huge demand to tokenize it. Today, if you want to invest in Sukuk, there is a lot of bureaucracy, a lot of steps to follow, a lot of approvals, a lot of things. So a lot of cash is waiting to be invested in Sukuk, but there is no a straightforward, easy way to put it there. So that's why a lot of people, the shortcut, what they do, they invest in funds, and funds will help them to make their money invested in Sukuk. If we take this part only and tokenize it, you're tokenizing a successful market, a successful bonds, a successful achievements where people want to put their money. You're just making easy for them to inject and put their money there. And on the other side, if we look at the whole halal ecosystem, it lacks of transparency. So it starts from halal certificates, goes to commodity trade finance, and then it goes to logistic traceability, and then to the investment in the project. There is a huge need now to do something called the whole halal ecosystem, or the whole halal circle tokenization. We call it, let's say, a halal passport token. So when you tokenize this process, with this token, you can see the halal certificate, you can see the trade finance happening in a Sharia compliant way, you can follow the logistics and supply chain, and you can see the Sukuk tokenization. It's a full transparency, and I want to say this is, yes, potential and important market, but it has to happen in a community governance chain. And this is one of the challenges today. Everybody wants to do this. He goes into on chains or a permission-based chain and try to say, I'm transparent and I'm on blockchain. But that cannot be the case, because you own the product, you tokenize it, you own the chain, and you own the people who are giving the permissions are your employees. So there is a lack of transparency. I would say now it is the time to jump into this, because there is a big market, a big demand, a big liquidity. You just need products to be available in people's hands to serve them and to provide value.
Yep. Would you like to add?
When it comes to challenges, I really like what you mentioned before, the liquidity trap, essentially, right? And this is not typically what people hear on panels, I would say, but something that I saw, also in practice, is you have to truly understand RWA assets. Don't magically become just liquid, right? There is a chance if you do not understand the asset flow and the process that you, as an issuer or as a buyer, right, you will turn a illiquid brick into an illiquid brick on the blockchain, right? So this is a true issue that it has happened. So, and the issue from the other side, when the assets get minted on the primary market, the primary issuance of this, let's say real estate token or any illiquid asset token, it needs to have the matching secondary market liquidity on chain. So how does this secondary market liquidity come onto chain in the first place, right? There's quite a few steps for you to be a large stablecoin holder, right? And if you have a stablecoin on chain, it typically generates relatively high yield, much higher than in traditional financial industry, if you think about it, right? So for somebody to place a secondary market order to acquire the asset, it typically should pay a higher yield, yearly yield, than the stablecoin liquid. I mean, it has to make sense for them from the opportunity cost side of things. The yield needs to be higher in the potential token that they're interested in. And yeah, this is true for some certain markets, right? But for some real estate markets, it's very, very difficult to outcompete, borrowing and lending yields or just stablecoin yields in general. If you take a look at the stablecoin, let's say lending vaults or something like this, you see, 10+% there, right? With real estate, this is difficult to achieve. So what I'm trying to say, both from a problem solving thought for asset issuers but also asset buyers, is to double check what is the secondary market liquidity for this type of asset that you're trying to work with. Typically this is solved by on-demand liquidity, but this is it's a asset flow process that you need to fully understand to not own an illiquid brick then at the end of the day on the blockchain. And if you are relying on redemptions, ideally it should be instant redemptions, difficult to achieve. Why is it difficult to achieve? Because the asset, the issuer, right, of the RWA asset is essentially the buyer of this asset, right? It's with a broker. When you sell the shares to a broker, you sell it back to the broker. So, and real estate tokenization platforms, they typically do not have the infrastructure to be a full broker, right, as well. So this is like some issues and the challenges that I saw in practice. So it very, very much is proving the point that you also said, yeah.
This is going to be an impactful point for sure. What we call it's not really a brick, I agree. You're not turning it into a brick, but it can become worse than a brick. That's what, and I think people have to have this very simple idea what is happening. It's actually not complicated. You have let's take real estate, we took real estate. You have a real estate in Manhattan. You want to have more trade for that real estate. It's really illiquid. It's sitting there. I bought it as a pension fund. When I buy it as a pension fund, it's stuck in my balance sheet. Suppose the stock market drop, I want some money. I can't take it like sukuk or bond, and I take it to a bank, and I say, look, use this as a repo, give me some cash, I deal with my things, and later on, I have to sell. You know what you just did with RWA? Because I'm going to come back to the brick. You open up the flood. Wow. I can turn something sitting on my balance sheet more liquid and trade it. What you do, you open an SPV, the SPV special purpose vehicle, buy the asset from you, and they split it into 100, they sell it to different people to trade it in the UAE. Good. Tomorrow, the price drop of that real estate by 10%. You hear some new regulation in New York, the rent gonna freeze, we're gonna freeze rent, not gonna be any rent, this is happening. And basically they're gonna say, look, oh, this real estate dropped by 10%. You come to the UAE, all of you now say, oh man, this is going bad, I wanna sell. I'm gonna come to the point he just mentioned. Half of the people wanna sell, let's say. There's nobody on the other side to get the pay. What are you gonna do? You need to sell the asset. You're not gonna sell the asset. The asset is still illiquid. The asset is sitting in Manhattan. You need to sell it, but it's gonna take some time to sell it. What's gonna happen now to your token? Even if the asset dropped by 10%, your token might drop by 90%. It means you just turned the brick into a big stone. People are losing their money in the RWA because of a 10% drop. Now that's the risk that happens sometimes, not all the time. There is 90% of the benefit exists, but there is risk. And because of this risk, the second point the gentleman mentioned, Ben, is the yield has to be higher. You mentioned you need to be compensated for that extra risk you're taking, which is turning the brick into a stone, and that's why it's going to be an interesting product, and it's going to compare with the other product, because now it's giving you 7%. Oh, it's risky because I'm going to have the liquidity illusion. I want 10 for me to trade it. And that's the equilibrium you're going to reach. It's going to have more traders, they gain more yield, and they're going to compensate for that illiquidity trap you have. I just demystify. My job, I just copied him, and I just make it a little bit longer. But that's the point.
And I just want to also maybe bring one more issue challenge to the table, which is cross-chain liquidity. That is basically really, that's something that we see big liquid markets on the EVM chains mostly, and then basically what will happen on the other chains and how we're going to solve. I would say that it's basically interoperability is the big issue for the whole market itself. But this is the solution that we have right now is basically intent-specific solutions like what we do in 1inch, basically, we'll take a moment to share, is where you have this intent and you put this intent to swap one real-world asset to another on the BNB, like Ethereum to BNB, or better BNB to Ethereum, it doesn't matter. And then there is a certain liquidity providers, like market makers, we call it solvers, who are fighting through the Dutch auction, and basically once the auction compete, they can serve this order, and they can gather liquidity all over the market. It could be their private liquidity sources, it could be centralized exchanges, it could be decentralized DEXs, it doesn't matter what. So this is the way how it's solved, but it still takes some time. It's like up to 3 minutes. It depends on the asset that is basically person wants to swap. But what are your vision? How we still can improve? What else we can do for that? What do you think?
Well, I would say, well, liquidity is very important, but we're talking about cross-chain liquidity, which is something I believe technology creators and technology provider can solve it. And there are a couple of solutions I've seen happening now in the market which are addressing this. But let's talk about the liquidity challenges from a different point of view. When we talk about real-world asset tokenization, usually when we say we, I mean the people who are in the domain of Web3, who are creating either projects or technology. We are talking about it as we are isolated in our books, like just talking to the crypto native people. We're forgetting two things. We're forgetting the non-crypto native people, and we're forgetting the other conventional institutions that are outside the crypto circle. We have to talk to them in a way and in a language that they can understand it. I was in discussion just before the panel with His Excellency Major General Abdullah and Her Excellency Madam Salwa Al-Hajri. I'm honored to have them today among the audience, and they brought my attention to one important point. It's like when you talk about a tokenization of a real-world asset, I mean, the non-crypto native people, they don't understand what does it mean. And we will only success if we tick two boxes. One is to present this in a way that non-crypto people, non-crypto native people can understand it and they can digest it. And also the conventional institutions can be a hybrid injections with the crypto and Web3 people to make this successful. If we talk about real-world asset tokenization, now if I have a building, what people I've seen in the Web3 they try to do, he tried to do to be the one who tokenizes this, and he tried to be the one who can be like the custodian for the same asset, and he tried to market this to the crypto native people. It doesn't work like this from my point of view. There is an asset, then there should be a partnership with banks, for example. A bank can be a custodian for that assets because non-crypto people and normal people, they trust banks. I cannot tell them come and trust crypto or trust exchanges. I trust exchanges, I trust Binance, I trust others, but I cannot tell other people come and trust the same. They want a financial institution like a bank behind this. He can be like the umbrella. So if I feel the bank is a custodian for this asset, and there is a technology provider who is collaborating by the bank providing the technology, and it is presented to the non-crypto native people to come and inject their liquidity, we're going to get out or off-chain liquidity to come on-chain, and that's the target which we want to do to make this ecosystem bigger. The off-chain liquidity now is started to come through ETFs, through different solutions, but they will come only if these people understood it the right way. If we as projects founders on Web3 or technology founders could make it more simple and could create this bridge of collaboration with banks. I see banks in UAE started moving towards that. We've seen a blockchain-based bond that was issued by FAB on HSBC platform, and it was successfully listed on ADX. This is a very unique example. It's happening in a really good way, and I think there will be a lot of examples to follow this. Just we need to be more simple and more pragmatic to bring it into reality and to more community.
So every stakeholder in this, whole economy ecosystem, right? Both off-chain, on-chain, has its own role. And what I see that works the best is that they focus on the points where they are the best, right? So banks, they are undoubtedly the best custodians, right? Taking care of the user, customer support, those type of things, right? Customer support, typically you don't get you cannot communicate with a layer 1 blockchain, right? If you're not an engineer or a developer, right? So what BNB Chain as a layer 1 tries to do is do the best it can to provide the best settlement layer. As a short update, we had 3 hard forks this year, which is a lot for 1 year. There's last one upcoming now in the next quarter. So essentially, we decreased block times, so scaling the L1 from 3 seconds to 1.5 seconds, then from 1.5 seconds to 0.75, and now with the last hard fork, which is coming in very, very soon in the next quarter, is we're going to have block times of 0.45 seconds. So this is essentially positioning the chain as the fastest, one of the fastest blockchain settlement layers. But what is also more important, perhaps, than just this scalability of block times and transactions, right, is the actual finality of transactions. Finality, so between block times and actual finality, this gap is literally a time range where somebody can still veto some transactions. I mean, not in the real world, but let's say that transaction is not fully confirmed. It is confirmed. You see it from your wallet and your interface, but it's not settled finally on the transaction. And BNB Chain delivering, close to 1 second finality is leading for all EVM-based systems. So this was hard work from our technical team. That was the main focus, and this is the focus that we're trying to, push and be the best settlement layer globally, while providing the best developer experience as well. And this is essentially where we see that brings, institutions from the technical perspective. When it comes to the adoption perspective, distribution is extremely important, and we're very, very fortunate to have great ecosystem partners, exchanges. One of the exchanges that we work with obviously also received a ADGM license just yesterday, if I'm correct. I'm not sure. So those are the key unlockers for the future, where people already have their own, semi-custodial, let's say, wallet. And this distribution is then going to be crucial for RWA assets for 2026. 2026 is going to certainly be the year that we've been waiting for a long time when it comes to the RWA narrative, for sure.
Okay, back.
If you
well, the question is, if I remember, the question is more.
We can slightly
the
move to
interoperability,
the scale.
interoperability between different chains. Because I always like to come back to the question: how do you make sure to go from one chain to one chain?
Yeah.
And I want to make sure that we are talking. Remember, you tokenize your real estate, you bring it on chain, and I told you needed more liquidity, because if you don't have liquidity, it's a trap. You get into a trap. You need more liquidity there. Hold on. But now you just heard, I'm going to take that part of real estate, put it in this chain. Part of this real chain is in chain. Another one is in that chain. What does that do? That limit liquidity more, and you have a problem. What is the problem? Is the technology is a problem. If you do it in Ethereum, you can do it in ERC3642. That's the token that will allow you to have the KYC within it. Because here we're talking about real estate and treasuries. KYC is still important at some point. And come back to what Muhammad was saying, we need We need words that the industry know. But we don't want to call it asset-backed security because the word security will come up, and as soon as it comes up, it becomes a problem because it is an asset-backed token. But the whole industry knows how to do it in Web 2. We have asset, they generate token, they generate return, and we bring them, we create SPVs, and that SPV create securities. Now, instead of creating the securities, we're going to create token. The problem with it is it's going to be hard because the technology is not if you have something written under Ethereum, which is, let's say, the 3642 ERC, it will not communicate with the token 2020 in, what's that, the one that Trump issued his token in?
Solana.
Solana is ERC 2020. And then the 2020 will not communicate with this. It means now I manage to tokenate my real estate, but my gentleman here, he's in Ethereum. You're dealing with the others, and this table is in Solana. And we want to connect. We want to connect to create liquidity.
One inch will connect.
But that create what? What's that create? Create 3 risks. Need to trust you, need to trust you, need to go trust her. And here, I give a little bit flair to the UAE a little bit. When I was in the plane, I read something they are doing. Just came in today, leaving today. They did something interesting. They are doing something that may solve what Mohammed was talking about. He said the word bank. I think they're actually doing something, I think, better than that. They're introducing something that the technology firm, without being a custodian, can be a non-custodian holder of assets. But they establish a regulation to become a non-custodian. Think about it as an MPC, multi-sig, all that stuff, which is actually a middle ground. Is it good, is it bad? We can debate it. But in sense, they are, in fact, they knew who the person do it. I'll go shake his hand. He's doing something good. There's something good being done in ADGM. I don't know who's doing it, but something is thinking correctly in there. They don't want to go bank because they will lose everybody from the crypto side because now the QSE is bigger. They are doing something in between. That will help a little bit the interoperability, but I don't think technology is there yet. Maybe you guys do it. I will check the.
Yeah, feel free to check. And this is what. Yeah, there is no like bad and good in the
I'm
custody.
really bad. Well, I send a lot of emails of questions.
We're all discussing about the like how TradFi killed DeFi. There is no like nobody killed nobody. So basically, everyone we are growing in parallel. And yes, we're also already in discussions with the several custodial/banks. And in my ideal world, when I'm entering into the neobank or app, there is a 2 option whether I want to do it in a custody way or in self-custody way. And right now, the farms like Ondo Finance, like Xtos/BackFi, which is backed by Kraken. There is several other tokenized assets that tokenizing the Tesla assets, Apple assets, in a self-custody way, and like there is a trading firms like 1inch where you can trade it in the self-custody way with on BNB with a Trust or Binance Web3 wallet. So it's already existing, and what we are missing really to scale, jumping into block 3, I will share my thought, is just basically to educate custodials on how to define in a proper way. So we're talking, you have to, I really like the word, Mr. Mohammed shared the thing that you have to be very simple. So you go to bank and you basically showing in a very simple examples on what is basically trading Apple on the I don't know, on different, in any banks, Revolut Bank even now, in a self-custody way. Education is something that we are still kind of missing. We are trying to onboard Web3 DGNs by just showing the value. Hey, you can gather some money from that. But instead, we have to start to educate. What is the value behind of the crypto? What is the technology behind? How it makes your life and the quality of your life better? What improves in your life if you use this technology? And not saying, hey, go and do X10 in one of the digital assets. That's what we're missing. Like completely reframe the way how we're onboarding people. And then once they understand in deep, I like the way how you're basically sharing to the audience the very complicated sometimes stuff in a very simple way. That's what we're missing. Like, talk with the people by the value that you were bringing, and then they will start using your solution. That's maybe how we can scale real world assets. We talked about the basically digital assets, NVIDIA and Apple, but there is also the big market for the, as you mentioned, real estate. Go to talk with the biggest developer, even in this region, show them the value, because they're scared of the technology, because they don't understand the value. You say, yeah, you can do X10, you can sell your apartments 10 times faster, but they are not understanding the why. And once you start to explain them why, they will most likely use, I hope so. This is this is my goal basically in the industry, to educate and onboard more people, and that's how we can move forward. But we have 5 minutes. Please, maybe jump into the block 3. How do you think we can scale even more the RWA assets industry itself? What's your vision here? What do we need to improve to onboard more institutions and real people?
I think I will start from the point you just mentioned, which is how to make people understand the value. And before that, we need to provide a real value to people, then start explaining it. Something we are doing related to this on Hug blockchain, we are creating something called a value token. And we are figuring out now how to make it regulated. But this value token, it will represent different applications and different projects that's been implemented on the blockchain itself. So the people who are holding our coin can swap it with a value token, and that will represent their shares on these applications. This will mean you're not just contributing by holding this token, you're not just having a store of value, or you're not just contributing on the network stability or security, but you can be also partner on whatever is happening there. So we create a more value proposition to the people. They can understand this. And also, I would say more transparency is very important, because as Ben correctly said, and also Dr. Ridwan, first we're bringing things that mostly will be like illiquid, and we're bringing a secondary liquidity level to them, and that's very good value proposition, but it needs to be done in a very careful way, in a very well-structured way, in a very simple way. I can summarize what I say is that we need to create a hybrid model that can bridge the traditional finance and the DeFi to bring a better liquidity and services to the RWA.
So essentially, we are now in this top-down adoption moment, right? So those are currently the biggest drivers of adoption. You saw, for example, also on BNB Chain and other chains as well, the launch of BlackRock products, Van Eck products, Franklin Templeton, other great institutions as well. So what you saw mostly at the moment were tokenized T-bills, right? T-bills are already one of the most liquid assets in the real world anyway, right? So they, why would they start with the most liquid first, right? So this is what gives you kind of like a sense of time, that they're just right now starting with the most liquid assets first, which is the safest, and they're using they're adopting the chains that are most established to some extent. So this maybe gives a good perspective at what time we're currently in. Those T-bills products, they're just the first that are going to come from those large asset managers, and those are going to be the main drivers of users. We leave it up to the institutions to to take care of the users the best they can. BNB Chain provides the best infrastructure, and this is what we try to focus on.
I think I may just take a little bit different stand than you, Alexandra, on one thing.
I'm happy to.
I actually think institutions do understand extremely well. This is what I spent my career as. Since 1998, I work in institutions. They do understand really well asset-backed security, like really well. That's what they lived with for many years. I'm talking about the asset managers, pension funds, and sovereign funds. They do understand what an asset security is, and they love the idea of liquidity. They basically, this is the best. The liquidity trap is the thing they understand the most. Now, when you are right, is because now you have a career risk. When you work in an institution, you want to jump into something. This is what I will agree with Mohammed and with Ben. This is where transparency is going to come in, because I'm not just losing money, I'm losing my career when I'm going to jump in and invest in something that my board members, and remember the cycle of board. Anybody who works in the cycle of board, even today, if I think an idea is beautiful, I present it to the board member the next quarter, they will say, yes, you can. No, you cannot present. First, you have to tell them to want to present it. They approve it. You present it in the next, you have to be, because you already set the whole Q1, Q2, Q3, Q4 is already known. It will take a year at least before you get approval. A year, if you're lucky. And those guys, if you don't do well, and you come up in the news that the RWA was actually a problem, you lose your job. Kids don't go to school. That's where it's not the fact that they don't understand that they want dissemination. I think the hammer is transparency. If you give them very clear transparency, and the T-bill is the perfect, that's why I said I'm going to come back to you. Look at what they did in the T-bill. There was a company separate that does KYC, separate one. Anytime you buy the token, they know exactly who's buying the token. There's a company that's actually bringing the treasury, and there's a company with the BlackRock, and there's a company actually that actually does the third work. It was a very, very clear distributed roles that I, as an asset manager, can say, this is regulated, and they know who they hold them. This is regulated, they did their job. Oh, they didn't do well, it's not my problem, it's another one. It means you have to take this angle when you talk to institutions, is the angle of a career risk of each one. Is not just understanding the concept, but if things go south, I don't like this expression because I live south, I'm Moroccan. If things goes wrong, if things goes wrong, what thing's gonna happen? You know what I mean?
Yeah.
That's, I think, the key part. Transparency of regulation, transparency, transparency. It's like real estate. Location, location, location. Blockchain, transparency, transparency, transparency. That's it.
Thanks a lot. This is really a good end point. We're actually running out of the time. What I wanted to say is that we're all working in this beautiful industry, and the goal of the builders is to onboard more people to the crypto and make the mass adoption happen. And I want to ask everyone who is sitting here today to find at least one person who non-crypto related and educate them on how to DeFi, how to install 1inch wallet, how to go to BNB Chain and swap real-world assets. And then basically we at least double the audience in our beautiful industry. Thanks a lot for listening. All speakers will be outside to basically answer your questions. Thanks for beautiful speakers. Thank you, guys.
Thank you.
Thank you much.
Thank you.